Hi, I'm Asit Bhandarkar. I'm a fund manager with JM Financial Mutual Fund for I think almost 17 years now. Overall, I have been in equities for almost 22 years now. It's been a rewarding, fruitful journey. I always wanted to be fund manager, a person who deals with equities, a research analyst at core. I grew up in very exciting time. India fundamentally changed in 1991 when we liberalized, and it really opened up tons of opportunities for Indian businesses. Ended up being a watershed moment for the businesses, for the country. And to that extent, I guess it tickled my interest as far as analyzing these businesses are concerned and kind of wealth that can be created in a free market economy. In that sense, very lucky because validated the thought process over the last 22 years has been quite rewarding. I would sort of think that I started my career, ScanX was around 3,000 and we all know where ScanX is today. So it's been a wonderful and rewarding journey personally on a career front. JM Midcap Fund is categorized as a midcap fund. So as per the category, we are supposed to hold at least 65% in stocks which are categorized as midcap. The benchmark is BSE Midcap 150. And the rest of the 35%, the fund has flexibility to buy the large caps or small caps as the case may be. From a fund's perspective, we are growth focused and in our philosophy, and to that extent our fund has a good mix of stocks and sectors which are high growth at the same time where the quality aspect is very well taken care of. We do understand that the mid-cap segment is a segment where companies have sort of become larger, so they are no longer having the uncertainties which perhaps come with the micro caps and small cap category, and at the same time they are not so large that they cannot grow very fast. So what we are seeing typically is in the large cap category, companies may be growing at say 15%, but in the mid cap category, there are companies which can easily grow at 25%. And I think that is the crux of this fund, that you have reasonably well discovered companies which are growing at a fast pace. From our side, on the fund management side, our responsibility lies twofold. One, to make sure that we don't overpay for this growth promise. So we have to be a little careful about valuations while we allocate money here. Second, we have to be very, very focused about the quality of the stocks that we buy. Because we have in the past seen that, high growth phase is a phase where there can be. So our job in that sense is to avoid accidents. Our job is to probably try and pick stocks which can be the leaders of tomorrow. I think specifically, not about the mid-cap fund, but what I can tell you is that the JM Midcap Fund is looking at high growth opportunity stocks. What you will realize today in this market is that midcaps as a category itself, probably the most expensive category among the different categories that are in the market. Large caps are the cheapest, small caps are little more expensive than large caps, and mid caps are the most expensive. So to that extent, investors may sort of perceive this to be a little high risk kind of position to be in. But the fact is, and I think this is what the investors have to keep in mind, is that these are companies which are well established, where the growth trajectory is well known, and to that extent market is willing to pay them a higher valuation. What we have seen is that there are companies in the past, if I were to just take some names for our investors to understand, a trend probably would have been a mid or a small cap 10 years back and has become a large cap because of a high growth trajectory that it was on. And in this whole period, this was never a cheap stock. This is a category where stocks may not be necessarily cheap, but the growth trajectory is well established, and if the company executes well, then the rewards that the investor gets are far more than you can get in the large cap segment. Investment process that we follow in the fund house as a whole, what we call the geek philosophy, where our focus is primarily on growth of earnings of stocks. And so typically what would happen is we would pick sectors where the growth of earnings is very high to be overweight on, and then we would pick stocks within them which sort of are growth leaders. But we are very quality conscious, and we try and avoid all the mistakes that can come through during a growth phase of a company. We try and make sure that the return ratios of the companies that we buy are reasonably high. We typically prefer ROEs of about 15%. We ensure that the debt equity of the companies that we buy is very comfortable, maybe less than 1, or probably no debt also. And we also look at the cash flows that the company generates. We are reasonably averse to companies which do not generate cash flows. Markets are now at a very interesting stage. We had an excellent run in the markets over the last 1 year, driven by strong corporate performance, but also driven by very strong flows. As things stand, we are seeing that as geopolitics is playing out globally, FIIs seem to be exiting Indian market, and to that extent, I think it's less to do with the opportunities available in India for them, but it's more to do with the opportunities available ex of India. India, to some extent, looks a little expensive relative to the rest of the world, and we believe that after this adjustment phase is through and there is a little bit of a time correction that we'll see, our market should do quite well. Meanwhile, I think we are seeing very strong domestic flows. There is a strong floor and support to this market. And we would say that, this is a great time to allocate money to the market, because last few years, it has been a one-way upward move in the markets. An investor has not really got an opportunity to put good capital to use at a fair valuation, because every month the market would just keep going up. I guess we're in a phase of volatility right now, but I would urge the investors to look at this as an opportunity, because this is a point where you can allocate capital over a period of time, and if somebody has a view of 2 to 3 years, it will be probably a reasonable period for an investor to make reasonable returns from here. Well, that's quite dynamic. I think in India, typically sectors associated with consumption will do well. What we are also seeing, as there are uncertainties with the global trade and the geopolitics globally, we would think that companies which are domestically focused and companies where they are benefiting out of the manufacturing renaissance in this country will do quite well. So as we look at the opportunities, we do see manufacturing revival as a good story to play over the next few years. We also see that consumption, which has been sort of depressed in this country, will sort of start reviving on back of a good monsoon this year and perhaps even next year. So the rural economy should also start doing very well, and those sectors which are associated with that should also start doing quite well. From the current context, the investors should be mentally prepared to see some volatility. In the last 4 years, investors have really been, in that sense, very fortunate to see strong returns, and it has been sort of a one-way move that the market has seen. Incrementally, although we feel that the India story is becoming stronger from here, in every respect, macros are improving. We are seeing also the benefit of a lot of government policies on the PLI side, on indigenization in defense, etc. A lot of other sectors like railways, etc. start taking strong foot on the ground. After a long time, manufacturing sort of is going to start growing at a significantly higher pace. So opportunities are significant, but because the valuations in the market are a little high right now, we are going to see some volatility. At our end, we keep a hawk's eye on stocks and sectors that may cause volatility. We will also see sectoral rotation, stock rotation. As every time get at a higher valuation, we have always seen that there will be a sharper and more deeper volatility on any news which is either negative or positive. So we'll have to bear all this in mind. As fund managers will do that, but as investors also, I would think that we should take this phase in the market as a phase where you can allocate your capital very peacefully. Please do it in a disciplined manner, and ride out volatility. Please keep in mind that in the longer term, equities are probably one of the best vehicles to get superior inflation adjusted returns. All I would say is that keep reasonable expectations and you will not be disappointed. Treat volatility as a friend, don't be afraid.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.